Digital assets are now legally recognised as a distinct category of personal property in UK law. The government's reportedly preparing to ban cryptocurrency political donations, citing concerns over transparency. Official figures show that the UK economy shrank by 0.1% in October 2025. The US has reportedly suspended the £31 billion technology prosperity deal with the UK. Hi everyone, with the UK economy officially contracting again, the Bank of England's December interest rate cut, and the UK government confirming that crypto legislation will be implemented in 2027, there's a lot going on. And we need to understand exactly what the UK has actually delivered this year in 2025, and what the specific tax and regulatory changes mean for your portfolio. In this video, we're going to cover the new DeFi tax rules, the FCA's growth commitments, the controversy surrounding political crypto donations, and the irony of traditional banks facing massive fines. Just a quick reminder that nothing contained in this video is financial advice, and let's jump straight in. First, let's look at what the FCA has actually been doing in 2025. In a recent letter, the Financial Conduct Authority stated that it has met nearly all of the 50 growth commitments that it set out at the start of the year. Under the part of the letter called Accelerating Digital Innovation to Enhance Productivity, they mention allowing retail access to crypto exchange traded notes, or ETNs, which officially came into effect on October the 8th, 2025, and that we've covered in previous videos on this channel. Moving on from that, there was another announcement in 2025, the Property Digital Assets Act of 2025, which has now officially received royal assent. This means that digital assets are now legally recognised as a distinct category of personal property in UK law. UK courts had previously recognised this in specific cases, which we covered in a video back in 2024, but this act cements it into statutory law with the aim of giving investors stronger legal protection in cases of fraud, theft, or disputes like divorce settlements, where cryptocurrencies now have to be treated as property. Looking ahead, the FCA has explicitly stated that progressing UK-issued sterling stablecoins is a top priority for 2026. They're opening a regulatory sandbox to allow firms to safely test stablecoin issuance before the full rules come into force. So while we don't have the full legislation yet, companies can test their ideas in a safe environment. Also, literally at the time of recording this video, the FCA has just released a consultation containing proposals on how they intend to regulate crypto trading platforms, market abuse, lending and borrowing, and even DeFi. And I will be doing a separate video on this next, covering all of the detail, so make sure you're subscribed to the channel and keep an eye out for it. But the government has announced that the legislation for all of this is set to come into force in 2027. This will bring activities like crypto custody, exchanges, and lending fully within the regulatory framework. So the roadmap is stablecoin testing now, with rules arriving in 2026, followed by the full statutory framework in 2027. It should probably be said that we have been waiting for years for this clarity and opening up of crypto in the UK that has fallen behind many other jurisdictions. So we are seeing very slow progress, although they do finally seem to be moving things forward. But as part of this regulation, a positive piece of news for crypto investors is an update on DeFi tax rules, because the UK government has published the outcome of its consultation on taxing decentralised finance involving lending and staking. Under its old rules, simply depositing your crypto onto a crypto lending protocol could be treated as a disposal for capital gains tax purposes. And this applied if you staked your crypto as collateral to borrow against it. This meant you could technically trigger a tax bill without ever actually selling your assets, which obviously doesn't make any sense. However, HMRC has now announced that it's developing an approach for a no gain, no loss framework. So if this becomes legislation, this would mean that the act of lending or staking your crypto would no longer be treated as a disposal. Instead, a disposal would only happen when you economically realise the asset, for example by selling it or swapping it for a completely different token, which seems pretty obvious. but this could potentially free up crypto lending in the UK significantly. The return or interest you make from that staking will likely still be treated as revenue, but the deposit itself is now safe from an immediate capital gains hit. If you're unsure how this applies to your specific situation or want specific advice on UK crypto tax, we've partnered with Miner, who are experts in UK crypto tax and can help you navigate these changes when they come in. Also, for tracking your transactions, you could use an automated crypto tax tool like Koinly, which could save you time, and I did a specific video looking at Koinly that you can find the link to here and in the description. We also have to mention some irony in the banking sector, because while the FCA has been incredibly strict with crypto firms over years, and therefore individuals, often blocking them from operating due to money laundering risks, traditional banks are ironically still facing massive issues. Just recently, Nationwide was fined £44 million by the FCA for failures in its financial crime controls. So we can clearly see the contradiction that crypto companies and individuals have struggled to get banking access for years due to perceived risks, and yet here we see a major high street bank or building society allegedly failing to stop millions in fraudulent funds moving through its accounts. Linked to this scrutiny, we're seeing a major political row emerging over crypto donations. The government's reportedly preparing to ban cryptocurrency political donations, citing concerns over transparency. In particular, parties including the Lib Dems and Labour have called for an investigation into donations received by Reform UK. While Reform became the first party to officially accept crypto donations this year, the scrutiny focuses on a record £9 million donation from a major crypto investor, Christopher Harborn. Although this specific donation was reportedly made in fiat currency, not crypto, critics have raised concerns about potential conflicts of interest after Nigel Farage publicly promoted the stablecoin Tether, a company that the donor is a major shareholder of. So this situation has fueled the government's argument that the intersection of crypto and politics needs tighter regulation. And finally, we have to look at the wider economic picture in the UK, which is looking increasingly difficult. Official figures show that the UK economy shrank by 0.1% in October 2025, likely leading to the Bank of England cutting interest rates by 0.25% on the 18th of December, with the aim of helping to stimulate the shrinking economy by making borrowing cheaper, which is normally a positive signal for assets like cryptocurrencies. Just a reminder that I do offer one-to-one coaching to those who are genuinely looking to educate themselves in the crypto space, with there being links in the description to contact me and booking a free video call to see if we'd be a good fit. The fiscal situation for individuals remains challenging though. While the autumn budget didn't introduce a specific exit tax or increase the headline capital gains tax rate for crypto, which were feared, it wasn't good news. The freezing of income tax bans means that as wages rise, more people will be pushed into higher rate tax brackets, and this is important because it will therefore pull more of people's capital gains into the higher rate of 24%. It also means that more income from mining, airdrops, or staking rewards will be taxed at a higher income tax rate. We also have the Crypto Asset Reporting Framework, or CARF, coming into effect from January the 1st, 2026. As we discussed in a previous video, this will standardize how crypto platforms report your data to tax authorities, like HMRC, making global crypto data sharing automatic between governments around the world. Also, the UK's ambition to become a global tech hub has faced a setback, because the US has reportedly suspended the £31 billion technology prosperity deal with the UK, with the UK government saying it is negotiating this. As covered in a previous video, this partnership was meant to boost collaboration on AI and emerging tech. So that ends this video, and as always, we'd love to know what you think in the comments below. We'll continue to track these developments into 2026 and 2027 for you and keep you informed. Thanks for all your support and feedback at Koinly. We really appreciate it. Just a quick plea from me, if you could please like the video and subscribe to the channel. It really does help the channel to grow and means we can continue to offer content for you moving forward. Thanks very much for watching, and and I'll see you in the next video.